Hi, welcome to this second installment of my lecture series on Assignment 9. We're talking about chapters 3 and 4, excerpts from chapters 3 and 4 from David Schweikert's After Capitalism. In this installment, this I'm thinking will be the second of 3 installments of lectures for chapters 3 and 4. In this installment, what we're going to talk about is the viability of the successor system or the economic democracy that Schweikert proposes, the economic viability. Like, will this thing work that Schweikert proposes as a replacement to the structure, the capitalist structure of governments, where you have a rentier class, the capitalists who live off of passive incomes. So remember, this successor system, this different system, this alternative to capitalism that Schweikert is proposing, has 3 elements. All the big firms are worker-owned and self-managed. So, you know, your Apples, your General Motors, your whatever, they're no longer owned by shareholders with stock through this capital system. They're no longer funded through a bond market. Rather, all of these larger firms are owned by the workers themselves, and the workers themselves own and manage the firm. They manage the firm through a democratic elective management, board, and all the profits for the firm get returned to the workers in the form of a wage for everyone that's working for the firm. There's no longer a rentier class deriving passive income off of their loans or off of their shares that they own in the firm. The second element is economic democracy keeps a market, but it only keeps markets for goods and services. So there's still a free market for goods and services, the things that these worker-owned firms produce, but there is no longer an equity market, there is no longer a bond market. The third is that there's social control of investment. And social control of investment, what that means is that there's this community banking system that takes the place of the equity markets or the venture capitalists, those kinds of folks who today fund entrepreneurial activity. Rather, what you have is a system of community banks that are funded by the state, where the state taxes the firms, gets a capital tax from the firms, and then recycles the proceeds from that capital tax to the community banks, and the community banks use that money to fund new ventures, expansions of existing firms, maybe new ideas, and these kinds of things. So that recapitulates our basic model. Last time we discussed this at length. Here's my little chart that I made up trying to describe this structure. I won't go back through that again, but if you'd like a refresher, just go to my lecture 9.1, and I talk about each of the little parts of each individual firm that makes up all the big firms in the economic democracy form of economy. This is what they will all look like. Okay. Now, something that Schweikert wants to make very clear is that economic democracy is an economic democracy in the sense that there's democratic control of the workplace and there's democratic control of the economy in general. There's worker self-management, so there's no longer Elizabeth Anderson's private government. Rather, inside the workplace, you have a public government in the sense that the people that work in the workplace elect their managers, and so there's a kind of accountability and self-determination there. There's also legislative oversight of these community banks that are funded by the state, that are the source of capital funding for all these firms. So that there's all the community banks ultimately are subject to the legislatures of whatever country where you find this economic democracy. The legislatures oversee and are in charge of making up the rules that constitute and govern and organize these community banks. So there's a way in which the control of the economy is taken away from this free market system and put in the place of folks that have a kind of oversight over it, whether it be workers electing representatives of their individual workplace, or it be citizens putting legislatures in place on a representative basis, and then those legislatures then oversee the construction and the rules that regulate these community banks that then use government funds to make certain capital investment decisions on behalf of the economy as a whole. And remember, it's not just one big giant community bank. The idea is that there's a whole network of competitive community banks, sort of like there's a whole network of universities that compete with each other when it comes to research or recruiting students and that kind of thing. Okay, now remember Schweikert's big promise. One thing he's trying to respond to here is the TINA objection. There is no alternative to capitalism objection. If you want a dynamic economy, you need capitalists to they must be incentivized to provide funds for entrepreneurial activity. And Schweikert saying, wait just a minute, here's my plan. I think this would be a way of organizing the economy where you'd still get that entrepreneurial funding that leads to this economic dynamism. So what's really important for Schweikert is he's able to at least make an initial case that his idea is viable. That there's a chance in heck that it's going to actually be able to deliver on this promise, but to be able to answer the TINA objection, there is no alternative direction objection. And for Schweikert, the way he divides up this question about the viability of economic democracy, whether it can deliver on this, into two different parts. The one question he thinks is important is the question that asks, is worker self-management something that's going to be efficient? If you're actually going to get firms that work well when the workers are in charge of managing themselves through a kind of representative system. The second question is, can the community bank system work? This publicly funded network of community banks. Why do we think that will work as well, or perhaps even better than capitalism? So let's take these two in turn, and beginning with the does worker self-management work question. Schweikert adduces quite a bit of evidence for the claim that yes, in fact, it has great promise. There's basically, I'm going to divide up his evidence into two parts. One part is he points to an existing, just gigantic worker-owned cooperative, or actually it's a federation of worker-owned cooperatives in the Basque region. That's the northeast region of Spain. So in this worker-owned cooperative is called Mondragon. If you Google Mondragon, there's a bunch of stuff. It's pretty well known, I think, in the business world as an example of a really big, diversified cluster of confederated cooperatives. He also just points more generally to evidence that worker-owned cooperatives can work. And so, basically, Schweikert's successor system model is to say, hey, we need to make the economy, all the big players in the economy, all the big firms, we have to just mandate that they all be worker-owned cooperatives. And his evidence that this can work really well is to find worker-owned cooperatives that exist today in the capitalist system. Because, of course, in the capitalist system, any firm can choose to organize itself in this way. It's just not, the thing is, they're not required to do that. In economic democracy, Schweikert wants to require firms to do that because Schweikert wants to get rid of the capitalists because he thinks it's important to get rid of this rentier class that lives off of passive incomes. He thinks there's an unfairness there, and as we'll see in the next lecture, he thinks there's some real problems that are generated by having folks who can make that kind of income. They cause a lot of problems for the world in general, he thinks. We'll talk about that next time. Okay, so let's talk about Mondragon. Mondragon is kind of an interesting thing. I just learned about Mondragon a couple of years ago, and I continue to be amazed as I read more things about it, that there is such a thing as this. So a little bit of the history of Mondragon. Mondragon began in the 1950s. It was started by a priest, Father Don Jose Maria Arizmendiarrieta. Sorry about that. That's as good as this Texan can do. Uh, so he established a school for working class boys in a small town in the Basque region of Spain. He's known. His nickname was the Red Priest because he's kind of a socialist leading lefty priest who organized Mondragon. And so the Basque region of Spain, particularly in the 50s, it was a poor, it doesn't have any natural resources. It's a poor region of Spain, underdeveloped region within Spain. And so the priest is there and he wants to do something about this. And he puts together a school. And 11 members of his first graduating class in his school, they go on to become engineers. And then 5 of those folks come back, and there's 18 others that they work up, and they set up the first cooperative factory to make small cookers and stoves. So they set up the very first workers' cooperative on this model, and Father Don Jose Maria Arizmendiarrieta is helping them figure all this out. He's kind of leading them with the organizational stuff. Now, from those humble beginnings, Mondragon today, MCC is what we're going to refer to as this constellation of cooperatives that all kind of grew out of this initial seed. MCC is the dominant economic power in the Basque region of Spain. Its capital goods division is the market leader in metal cutting tools in all of Spain. Same for the division that makes refrigerators, washing machines, and dishwashers. It has 75 production plants abroad. One of its sub workers cooperatives, Eroski's, the third largest retail food chain in Spain. Now all the grocery stores with this group, they've been turned into workers cooperative as well. Caja Laboral is the bank that grew up around Mondragon, and it too is organized as part of this cooperative system. It's commonly considered it's been assessed as, that's the better way to put it, it's been assessed as among the top 100 most efficient financial institutions in the world in terms of its profit to asset ratio. Another affiliate of Mondragon, cooperative affiliate, is Ikerlon. It's a research firm that meets NASA's technical specifications, and it helped work with the space shuttle, and it provided services and goods for the space shuttle. Mondragon University enrolls 3,000 students. It's considered to be the best technical institute in Spain. Mondragon has a workforce of 85,000 folks as of the writing of this book, and this edition of the book came out in 2015 or so. And anyway, that workforce is up from 43,000 in 2000, so it's robustly growing here. Its annual sales, as of the writing of this book, was about $194 billion, and that's American, and that's up from $6.6 billion in 2000. That's a huge increase. In fact, that's such a big increase that makes me want to double check my numbers here. Yeah, annual sales of 19.4 billion, up from 6.6 billion in 2000. Apologies for that. And then it's got assets of over $43 billion, up from 13 billion in 2000. Okay, another thing to note about Mondragon is it remained profitable in 2009 with profits of $80 billion across all the cooperatives. But something to keep in, so 2009 is an important date because, as you might remember from the Blythe lectures, 2008 is this banking crisis. There's this kind of collapse in the world economy, or not quite a collapse, an almost collapse, but stock markets got hit really bad, companies got hit really badly. There was it's called the Great Recession. It was a global recession, took a lot of companies out, at least took them down a few pegs. But NCC remained profitable during that period. And they did pretty well when it came to the 2008 storm. A lot of companies just laid people off, fired folks. Mondragon, because of its worker-owned, basis, it's resistant to laying people off. And so what it did during this period, it did experience a slowdown, right after 2008. It's rebounded quite a bit from it since then, but in 2008 it experienced this slowdown. And the way it handled it is that it agreed that 20% of the workforce would leave their jobs for a year, during which they would receive 80% of their pay plus free training for other work. So Mondragon, handled this slowdown in a way that it would be unique within the larger capitalist economy. That's not a typical way that a company deals with it, laying off people and giving them 80% of their pay while they're laid off and training. And today, even after the slowdown, or as of the writing of the book, total employment is still double what it was 10 years prior to the 2008 Great Recession. So this is the cooperative is doing pretty well, and it's doing well relative to other firms that are structured like typical capitalist firms. Not worker owned, with rentier owners, absentee owners, and the whole bit, like we've been talking about. Let me say a little bit about Mondragon's structure. So as I said, Mondragon's a federation of cooperatives. It's not just one. It's different cooperatives that do different things, and they're all connected to one another. Their finances are connected, and they support each other in various ways. Workers of each cooperative, they also are governed in a common structure, as you'll see. Workers of each cooperative, so there's all these little satellite cooperatives. Workers from each satellite cooperative meet in an annual general assembly to elect a board of directors, which then appoints the cooperative's management and selects delegates to the big MCC Mondragon Congress. So let's say Mondragon's made up of about 50 cooperatives or so. Each of those cooperatives every year elects their own board of directors, and then their board of directors then appoints the cooperatives, each particular cooperative's management, and it selects delegates from each particular cooperative to go to the big MCC Congress. This big MCC Congress, the big Mondragon Congress, it has a delegation of 350, and they pass judgment on the strategic plan for the entirety of the whole Mondragon system. And that's presented by a Congress board whose 22 members include the division heads of Mondragon, where the member cooperatives are grouped into divisions. So you'll have 6 cooperatives that'll be maybe like in the appliances division, and 8 will be in the maybe the grocery store division. So there'll be different divisions. So you have this 350 delegate sort of Congress for the entire Mondragon company, and they pass judgment on the strategic plan for Mondragon as a whole. And at the heart of this is a Congress board with 22 members, with the division heads of the various different parts of Mondragon. And of course, those division heads are also elected by the workers. And there's also some representation there from special institutions like the bank, the research organizations, the university that are associated with Mondragon as well. But the point is that this is a federation of cooperatives who make decisions about what the company's going to do, and they make it on a representative basis. All the workers in the cooperative have take a vote, and they put the decision makers into power to make these decisions. Okay, now let me just point out a few of the felicitous features that Mondragon, that Schweitzer points out about Mondragon. One thing to note is, given that the decisions are made by people who are accountable to the workers, the tenor of the decisions, or the focus, or the orientation of the decisions look quite a bit different than from a typical capitalist firm. So you might imagine that if the workers if they own the firm themselves, and the decisions for the firm are made on behalf of the workers by folks accountable to the workers, as opposed to folks who are accountable to absentee shareholders, that's going to make a difference in how the decisions are made, and what particular decisions are made. One difference that you see in Mondragon is it tends to go for employment creation rather than maximizing profit. So, we go back to, its response to its response to the 2008 recession was to, kind of furlough people for a year, and during that year, paying them 80% of their pay plus free training for other work, with the idea of hiring back as many of those folks as possible after the end of the year, which, in fact, they did to a large extent. But by contrast, look at what GE did, according to Schweikert, from 1985 to 2000, prior to the Great Recession. So GE, General Electric, a North American-based, huge company, multinational, tripled its revenues from 1985 to 2000, but it shrunk its employment from 435,000 employees worldwide to 200,000. So that contrasts with the orientation of Mondragon, which I just described, their response to the Great Recession. But also look what happens to the workforce of Mondragon from 2000 to until about 2015. Their workforce increases from 43,000 to 85,000. So Mondragon does what it does, hums along without downsizing. It doesn't seek efficiencies by letting people go, which is exactly what you'd expect when the decision makers are accountable to the workers who work in these places. The workers who work in these places are very unlikely to vote in favor of downsizing type decisions. Another thing that you see in Mondragon is you see the bank behaving in an interesting way. So in the Basque region, there's the Caja Laboral, which is part of the Mondragon structure, and it's analogous to Schweikert's community banks, but it's just one bank. It's not, and it's funded by Mondragon, basically. What Mondragon does. But what Caja Laboral does is it provides funds for expansion and new cooperative creation, as well as housing an entrepreneurial division to research market opportunities and to provide technical assistance to workers in Mondragon who want to set up their new endeavor. So the idea is that something interesting is that there's a bank in here that is trying to coax its own workers, provide opportunities to its own workers to engage in this entrepreneurial activity that, Schweikert admits is really important, something that we want to generate. And that's something that looks different than what you see in a capitalist economy. One final Felicitous feature, and you could see how this would work too, like if the cooperatives are worker-owned and the workers, they're all geographically bound, kind of tethered to the Basque region, so they're gonna vote for initiatives from the company where the company is going to invest into the community, into community infrastructure, things like parks and arts and things like that, because the firms themselves that are worker owned, they're not just going to have this exclusive interest in just profit that they can, pull out of the system and, send off to the absentee capitalist class. Rather, what you have when you have these worker-owned cooperatives, they're going to tend to vote for initiatives at the management level that will invest in the communities in which the workers live, because the workers will benefit from that those kinds of community investments. By contrast, the capitalists' shareholders, when they're absentee, they can just live anywhere in the world, and they do. They live all over the place. So if you have like somewhere that's owned by corporate shareholders that's operating in Hamilton, those corporate shareholders, they might live in Texas, they might live in Toronto, they might live in British Columbia or China or Germany. they're not going to experience any money that the company spends on the betterment of the environment in Canada or in Hamilton as a benefit for them. The shareholders won't see that. They won't feel that and experience that as a benefit. They'll just see it as a cost, as something that comes out of their profit, out of their dividends. By contrast, and this is a big deal, I think, for Schweikert, something that he thinks really recommends this worker cooperative form. When you have a worker cooperative, the people experience, the people who own the cooperative and who are ultimately the ones that are driving the decisions, the workers, they experience community investment. Say you had a worker cooperative in Hamilton, the workers that owned and worked in that cooperative in Hamilton would experience community investment by the cooperative as something that was a benefit to them. That's a big distinction between the typical capitalist model, where you have absentee capital owners, private owners of the firm, versus the worker cooperative model. And Schweikert, as we'll see when we get to chapter 4, he's going to keep pointing out things like that he thinks recommends this cooperative form of organization over the capitalist form of organization. Now remember, there's nothing really stopping cooperatives from forming in the current economy, but Schweikert's idea is that there should be laws passed that make it so that any company over a certain size must be organized in this way, with the idea of getting rid of the absentee capitalist class. And his claim is that you can get the same sort of entrepreneurial dynamism from a system like that if it's designed like the one he describes. Okay, so now here is one final thing about Mondragon. It's a kind of summary statement by this guy Hendrik Thomas, who's basically he's like a researcher at a business school, and this is he wrote this quite a while ago. You can go look it up if you'd like. But he has this little bit about Mondragon, just a summary capsule of his assessment of how efficient and productive Mondragon is. And he says productivity and profitability are higher for cooperatives than for capitalist firms. Now that's interesting. So here's Schweikert saying, look, here's this Hendrik Thomas guy who's noting that on this one measure, cooperatives actually do better than capitalist firms, productivity and profitability. So they can work. His successor system is economically viable, so argues Schweikert. And he cites someone like Thomas. Productivity and profitability are higher for cooperatives than for capitalist firms. It makes little difference whether the Mondragon group is compared with the largest 500 companies or the smaller medium-scale industries. In both comparisons, the Mondragon group is more productive and profitable. And then there's this more general evidence for the viability of the economic democracy worker cooperative model. And this, I think, analogizes to the kinds of things that you hear about the way people behave when they live in a democratic republic as opposed to when they're under some sort of dictatorship. There's a kind of energy in the population that makes them more creative and more energetic and just more capable collectively. But here's what this guy, Henry Levin, has to say about cooperatives in general, not just Mondragon. This is just a general observation of what happens to employment and productivity in worker-owned cooperatives. So here's what he says. There exist personal and collective incentives in cooperatives that are likely to lead to higher productivity. The specific consequences of these incentives are that the workers in cooperatives will tend to work harder and a more flexible manner than those in capitalist firms. They will have a lower turnover rate and absenteeism, and they will take better care of plant and equipment. In addition, producer cooperatives function with relatively few unskilled workers and middle managers, experience fewer bottlenecks in production, and have more efficient training programs than do capitalist firms. And so the basic idea, I think, is, look, if people own their workplace, and then they're liable to just kind of bought in and have a sense of empowerment and efficacy, and that it matters what they say and what they think. And the idea is that then they're liable just to be more creative and self-sufficient and more liable to do things to try to make the place better and work better than if they're just merely working for a wage, where they're where they're being told what to do. They don't have a say, and basically, if you for these folks that are just working for a wage, basically any effort they put into it is kind of something that is a cost to them. Whereas if you own the place and it's partly your creation, and all of the profits are coming back to you, or at least you and your fellows who are working together in the place, rather than going to absentee capital owners, you're going to get this kind of vibrancy and engaged buy-in that leads to a more productive and more efficient workplace. That's Henry Levin's observation. But the big picture is that, look, at least on this one prong, this one bit of economic democracy, this one aspect, making everything, all the big companies assume this worker cooperative, worker owned form. There's a lot of evidence, according to Schweikert, that this can work. That if anything, there's evidence that these can be more productive and realize greater efficiencies than the typical the firms that you see in capitalist economies. But that's not the only threat to the viability of the successor system model of economic democracy. There's a second challenge to viability, and that's the banking system. And that's something that Schweikert admits, well, nothing like this has ever been tried. You can see the viability of the worker cooperatives because there's actually things like Mondragon and other workers cooperatives, and we can study them and see that they work pretty well. But of course, there's never been this natural experiment where you just totally change the banking structure of an entire country, an entire economy. Get rid of all the capital markets, get rid of all the bond markets, and replace them with these publicly funded community networks of community banks. And so he says, look, this is the thing that I need to defend. Say that, hey, this is going to work at least as well as what we see today in contemporary capitalism. And I'm going to just point to a couple of things that Schweikert says, and then I'm going to kind of go off book and point out something that suggests that capitalist equity markets and bond markets aren't very rational, and so we might wonder whether whether we should really sing the praises of the efficiency of these things. But let's first start with the positive case for a kind of social control or government control of the capital decisions. And I think the argument against is just this basic economic argument that you'd hear is that, look, government interference in any market is going to distort the market. So if you have government interference in an equity market or a capital funding market of any sort, that's going to lead to suboptimal decisions and trades in that market. You're not going to get efficient funding, capital funding of the entrepreneurial possibilities in the economy. I think one of Schweikert main responses to this is to say, well, that's not so clear when you actually move away from the theory of these perfect markets that the economists have envisioned, and you look at how things go in the actual world. And one thing Schweikert points out is, look, the developing economies that are commonly regarded as these kind of miracle economies, miracle growths, are the cases of Japan right after World War II, and then later South Korea and other Asian tiger economies. Their growth has done much better than other countries that had lesser degrees of government intervention into the major decisions of the of how big capital is going to be invested. There's a kind of industrial policy in these countries that was state-driven, and these countries did very, very well and much better than other places that behave more as the theoretical economists might ask them to behave. So one counterexample is like, look, when you look to the real world, countries have historically done quite well with quite a bit of government interference at this kind of big picture strategic capital decisions, like what we're going to fund, what kinds of industries we're going to fund, what's going to be our strategy as a country. I'll point to one other thing, which is, like I said, it's off book, it's not Schweikert's, and I'm going to leave with this. And this is to say, is to just call into question the efficiency of the capitalist equity and capital funding markets. And to be really unorthodox here, I'm going to appeal to a tweet by this really interesting and I think very shrewd historian of capitalism. His name's Adam Tooze. He's at Columbia University in New York. He's from Britain. And so he has this tweet. A few weeks he tweeted out. And it'll take me a little bit just to explain what's going on in this tweet. If you want to find the tweet, I give you the URL is here on the slide. You can cut and paste that maybe. But it's about, what this tweet is about is the stock market rally that we've seen in the United States from 2009 to 2019. And here we have a graph on the right, well, as I look at it, at the right side of the screen, that shows this, really marked rally, 10-year rally in the stock market, taking us from the lows after the Great Recession in January of 2009 of a Dow Jones average, which was 7,500, all the way to this peak, which is almost hitting 30,000 in 2020. So if you invested money just in the generic Dow Jones index in 2009, you would have like more than doubled your money. That would have been a great time to invest. And that's this fantastic rally in these equity markets. And remember, these equity markets are supposed to be, the things that are funding the capital in these companies, and the equity markets are driving, who gets capital funding and who doesn't get capital funding, or at least that's the theory. But look at this chart on the left. This is Adam Tooze's chart that he tweeted out, and he said, look at how we're going to explain this tremendous rally in the stock market from 2009 to 2019. So this rally. So look at this chart on the left. What this is the source of purchases of U.S. corporate equities from 2009 to 2019. So meaning the source of purchases of the publicly traded stocks, like those that make up the Dow Jones Industrial Average. Now, if you see the blue line there, that's households. That's people's retirement funds. That's your mom and pop. That's folks getting on the day trading websites and that sort of thing. Look what happens to their purchases of stock from 2009 to 2019. This is households in the United States. You'll see that for almost the entirety of that time, that their purchases are negative, which means they're selling off their stock. So they're not putting money into this market. They're selling. They're getting out almost that entire time. Now look at this other line, which is there's a other domestic buyers line. That'll be folks that look more like the folks that are supposed to be making these smart equity decisions. They're the one. These other domestic buyers are the ones that are supposed to be making these smart decisions about where the money should go or where it shouldn't go. Who's got the hot entrepreneurial idea, and so we need to buy their stock, capitalize them. Now, if you look at that, those folks are getting out of the market too. That broken other domestic buyers line is for the entirety of the 2009-2019 period, they're getting out. Okay, now we've got the foreign sector, so this will be maybe China or some European countries buying into the maybe Canadians buying into American stocks. But look at the red line. This is the main thing. This is non-financial corporations buying stocks. This is the infamous stock buyback. What is a stock buyback? Well, basically, a stock buyback is when a company like Apple or a company like American Airlines, all the airlines did this, lots of corporations in the US did this. They take out loans on the bond market and they use the proceeds from those loans, or maybe they'll take some of their profits that they can't figure out what to do with them, and they will buy back their own shares. That red line is, by and large, corporations buying back their own shares. Now, why would they do that? Well, because the executives in these corporations, the higher level management, and powerful shareholders who can exert influence on the behavior of these corporations, they want them to buy back their shares to increase the value of stock, because this high level of management is going to hold a lot of stock in these companies, and of course the shareholders are going to own stock. They want these stock buybacks to jack up the price of the company's stock. Because of course, in any it's all supply and demand. There's a bunch of people out there chasing stock. The price of the stocks are going to go up, and the folks holding the stock are going to make money. Adam Tooze's point is that, look, when you look at this, what's driving this huge market rally from 2009 to 2019 in the United States, this is the equity markets that's supposed to be making these smart decisions about capital investment. What's driving it is companies buying back their own stock in order to inflate the shareholder value so that the folks that hold all these shares, these passive income earners, can get a whole bunch more. In fact, from 2009 to 2019, you just about, you triple your money. You certainly more than double your money if you buy at the right time and sell at the right time. So, but the point is, the punchline is, look, this is a capitalist equity market that is not behaving rationally. This is not efficient or rational investment decisions. This looks to be clearly a self-serving investment decision, an investment decision driven by folks who have the decision-making levers in these companies, driving these stock buybacks so as to increase the value of their own stocks so that they can make themselves wealthier. So what's the point here? So remember, our question is, someone might say, look, this whole community bank system, I don't see how it's going to make investment decisions that are as efficient and as fruitful as how those decisions would be made in a capitalist system. And Schweikert's response is like, well, look, there's a lot of countries that have done very well in directing these big capital investment decisions, like the South, like the Asian tiger countries. And then I'm going to pile on his behalf and say, look at what's been happening in these equity markets in the last 10 years in the United States. That there doesn't seem to be anything that's very rational when it comes to the question of efficient investment decisions and of generating greater innovation and technology. Rather, you get this kind of looting where companies buy back their own stock in order to inflate the price of the stock. There's no investment activity going on there. You're just getting a kind of looting of the of the coffers of these corporations. So it's not clear that this capitalist equity market is working very well anyway. And then that invites the question of, well, do we think the community banks are really going to be worse than that? And then we have this other evidence with the South Asian tigers that sometimes these kinds of decisions not made in this market-based way can actually be pretty decent. Okay, that's all I have to say. There's a lot more in Chapter 3 than what I've gone over, but I think the lecture will just get too tedious. And I think I've given you enough to kind of give you the picture of what Schweikert's doing in Chapter 3, his account of the successor system and his initial consideration of like the main kinds of threats to the viability or the plausibility of this alternative model are. Of course, none of this is dispositive. It's just an initial case, and hopefully it's food for thought and discussion on Thursday. I will see you again with my next installment. I'll have one more short mini lecture, 9.3, and then I'll see you on Thursday after that. Thanks a lot.